In this video, I will enlighten you about the nature of and differences between centralized finance, CeFi in short, and decentralized finance, Defi in short. And of course, I will give you some tips along the way on how to unchain yourself from the government and controlled system and move into the rabbit hole of decentralized finance, where you are the boss and holder of all the cards. Defi is the rising, new, unique decentralized financial system that operates without centralized banks, financial institutions, government interference, regulatory bodies, central servers, and gatekeepers. It works on a peer-to-peer system and is not controlled by any centralized entities. Everything in it is controlled by the masses and performed digitally via the notorious blockchain technology. The official currency in Defi is whatever cryptocurrency you choose. However, the rise of the Ethereum network as the king and future of DeFi means that the cryptocurrency Ether is the backbone of this evolving system. Hence, one must initially buy some Ether to enter the world of DeFi. In a nutshell, DeFi refers to digital assets and financial smart contracts, protocols, and decentralized applications, DApps, most of which are built on Ethereum. At first glance, DeFi might seem complicated and confusing. However, if you have 20 bucks or even less, you can unplug yourself from the centralized banking and financial system and go into the rabbit hole of decentralized finance by following these simple steps. Number 1. Go to any easy-to-use crypto platform such as Binance.com. Open an account, deposit as little as $10, buy any crypto, and begin trading. Number 2. Visit Ethereum.org, create a wallet, buy some Ether, and read about smart contracts and DApps. Number 3. Go to any NFTs marketplace such as OpenSea.io and use your Ethereum wallet to start an account. Then buy and sell NFTs and make money, or store and even grow the value of your digital or real-life assets while reserving all rights. Number 4. Check out any DeFi exchange, DEX for short, such as Synthetics.io. Learn, then begin trading DeFi securities. Number 5. Now that you're in the rabbit hole and have become your bank vault, a forex and stocks trader, and an assets owner and manager, secure your investment through becoming a centralized bank by utilizing stablecoins as a safe haven for your crypto when not trading and to protect the value of your money from volatility. I'll tell you now that the traditional centralized finance system, CeFi for short, is basically a system that is based on government-controlled currencies such as the US dollar or euro, aka fiat money, that are issued by central banks which are semi-autonomous and specialize in issuing, selling, trading, and buying all sorts of bonds and treasuries to control the money supply in circulation and keep stuff like inflation and interest rates in check. Stock exchanges are also a main component of CeFi. Alright, now I'll get into the details of the differences between DeFi and CeFi. Number 1. Central banks versus DeFi. Regardless of what you've heard, the main job of central banks is not printing money, but rather the responsibility to act as a governing body responsible for creating stability through regular research, study, and analysis of the economy, then setting interest rates accordingly while applying various strategies to decrease or increase the amount of money in circulation. Hence, central banks are creators of economic stability. For years, calls for the creation of something in the DeFi realm that helps in creating financial stability and security for investors have gone noticed. The result was the creation of stablecoins, which are based on blockchain protocols that have the principle of price stability encoded, so they fulfill the function of a reserve currency. The introduction of stablecoins set the foundation of the functioning decentralized financial system. It enables participants to engage with each other without the underlying risk of price volatility. Stablecoins are reliable for holding value over time without volatility and allow investors to easily transfer that value. In a nutshell, stablecoins such as Tether, aka USDT, USD Coin, aka USDC, or DAI, among others, allow an investor or any cryptocurrency trader to cash out their cryptocurrency investment without having to transfer it to fiat money, such as US dollar, because the value of these stablecoins is stable and carry no volatility risks. Stablecoins maintain substantial reserves of fiat money and other assets, including other cryptocurrencies. Hence, they are backed and stable crypto. I would not be surprised if they already have or will also use gold and real estate as reserves. Number 2. Investment financial institutions versus DeFi. In CeFi, investment financial institutions are private companies engaged in the business of dealing with financial and monetary transactions such as deposits, loans, investments, and currency exchange. Financial institutions include banks, trust companies, insurance companies, brokerage firms, mortgage companies, and investment dealers. Governments are obsessed with controlling and regulating financial institutions because they do play such an integral part in the economy. Historically, they can cause recessions because for some reason they are stupid enough to suddenly go bankrupt. An example of this is the collapse of the investment bank Lehman Brothers on September 15, 2008, which led to a full-fledged international banking crisis and recession. As for the DeFi protocols, they do indeed offer products similar to those offered by CeFi investment banks. For example, Synthetics is a derivative issuance protocol which enables decentralized creation and trading of derivatives on assets including stocks, currencies, options, and commodities. Complify is an issuance protocol on Ethereum for derivatives that do not default. There are no collateral calls, no liquidations, no counterparty risk. In a nutshell, they offer unique derivatives and exposure to real-world assets on the blockchain. Number 3. Stock exchanges versus DeFi. Traditional stock exchanges are markets in which shares and other financial securities of publicly held companies are issued and traded. The Nasdaq and New York Stock Exchange are examples of popular, well-known CeFi stock exchanges. And believe it or not, crypto trading platforms such as Binance and Coinbase are considered centralized exchanges because they allow exchange between crypto and fiat money. Binance and Coinbase, among others, operate in the same way the Nasdaq or NYSE do because transactions are handled by the exchange itself via an order book that establishes the price for a particular cryptocurrency based on current buy and sell orders. On the other hand, in DeFi, there are decentralized exchanges, DEX for short, where holders of crypto don't need to leave the crypto space to swap their tokens. An example of a DEX is Uniswap. DEX is compiled of smart contracts that hold liquidity reserves and function according to defined pricing mechanisms. The automated liquidity protocols play an important role in developing an independent decentralized ecosystem without any CeFi intermediaries. In a nutshell, decentralized exchanges are simply a set of smart contracts. They establish the prices of various cryptocurrencies against each other algorithmically and use liquidity pools in which investors lock funds in exchange for interest-like rewards. Number 4. Commercial banks versus DeFi. One of the pillars of the traditional centralized finance system is commercial banks, which are money lenders, and that's their core business. They also act as a vault where people can stash their cash in return for bonds and treasuries, which grow in value over time. Hence, the stashed money also grows in amount. On the other hand, in DeFi, there are protocols that enable unknown participants to both lend and borrow resources on a wider scale without involving intermediaries such as commercial banks. These DeFi applications bring lenders and borrowers together and determine interest rates automatically according to supply and demand. Anyone can get involved in these protocols. As for security and insurance issues, usually you have to possess some collateral, such as cryptocurrencies, to take out a loan. You can also be a lender and issue loans and profit. DeFi takes away power from the big banks, government, and the super rich and gives it to the masses. DeFi is way more democratic, incorruptible, inclusive, cheaper, scalable, and faster than CeFi as long as the venture capitalists are kept at bay. Even central banks are predicting that DeFi will continue growing and expanding. They even see them as a threat. Hence, it is safe to assume that the global financial system is already well on its way to becoming a two-tier system of DeFi and CeFi, and the choice is yours. Would you like to learn more about business, entrepreneurship, and personal finance? Click on one of the videos that showed up on the left, or go to our channel to find other interesting topics.